Hey guys, Stefan here. So, welcome to the Bitcoin Weekly Update for Sunday, the 10th of June 2018. I'll try to make it a quick digest of the key events in Bitcoin over the last week. So, I normally start with some statistics. So, we have about 9,900 Bitcoin full nodes that are reachable. We've got about 2,400 Lightning Network nodes that are visible. The price is around 7,300 US, which is around 9,600 AUD. The hash rate is around 35 exahash, and this has actually jumped quite a lot in the last 2 weeks. We're currently about 17 million of the 21 million coins that have been mined. And then the long-term thinking hold return. So if you've bought Bitcoin and held for 1 year, you are sitting on something like 164% return. If you've been holding for 2 years, you're sitting on about 1184% return. And if you've been holding for 5 years, you're now sitting on something like 6,700% return. And then finally, we've got the Mayer multiple. And so this is the ratio of the current price against the 200-day moving average. And this is currently at 0.72x, right? And so this multiple, at this multiple, based on historical data points, we have historically been higher than this multiple 90% of the time. So first, we've actually got a tweet storm by one of my friends, Neil Woodfine. And he is basically explaining why a lot of ICOs are just money grabs that are unnecessarily shoehorning a token into their system. And in many cases, this token is just sort of interposing an unnecessary extra layer of complexity and requirements. And it's not that these tokens reward or incentivize market participants any more than just charging a straight up price, whether it's in Bitcoin or whatever. They just tend to introduce this unnecessary friction. And the other big problem that he points out is that the incentives are totally wrong. It's all front loaded. So these ICO token companies and the developers, they just make all the money up front, and they can often dump this token onto the sort of unsuspecting retail investors, and after they're done dumping, who's left to build? So the other thing is that these tokens can have temporary liquidity just at the time of their launch, but what happens 1 or 2 years down the track? Who's going to actually provide liquidity in these tokens, and who has an incentive to even continue holding these tokens? So these are just some questions that just have not been really sufficiently answered. And what we're seeing, just to add some of my own thoughts, is that we're seeing some people who just build up a reputation in the crypto world and then just cash that in to make a coin or an ICO that all their fans buy. And we're also starting to see now with the Kick ICO, this guy basically raised 100 million using an ICO, and he himself has come out and saying, oh look, I think blockchain is unconvincing. Unless you're trying to build one of the most used cryptocurrencies in the world, it's very low odds that a blockchain is going to create value for you. And then if you were to contrast this with Ethereum dApps, decentralized applications, the number with an actually convincing daily active user base is quite low. There are only 3 over 500 daily active users. So yeah, and then contrast this now with Bitcoin, where holding is using. The fact that you have this easily saleable, hard to confiscate, limited in quantity, and no counterparty risk asset, that is a use. So next we're seeing this story, the blockchain firm R3 is running out of money, sources say. And when we say blockchain here, we're talking more like enterprise blockchain, aka the people who push this narrative of the blockchain, not Bitcoin narrative. So for some time you would see traditional finance executives or central bankers and so on, maybe a couple of years ago, will come out and push that vision. And R3 was one of the companies who did come out and push that vision. And you can see here there's this image of Charlie Cooper, who's the MD, saying, do you need the currency idea to leverage the technology? We strongly don't believe so. And so now some of this news that's come out recently shows that, yeah, maybe that was an unrealistic pipe dream, which in my view makes sense, because blockchains are not an efficient way to store and transmit data. They only make sense in very limited cases, such as making a money, where you need censorship resistance and you need that decentralization. And it was interesting to see that companies like R3 backed away from the term blockchain technology, and they tried to shift a little more towards this distributed ledger technology a couple of years, like 1 or 2 years ago. And so now it's funny that you can see in this article that there's rumors of them running out of money. And you can see here that they've been run more like a sort of plush consulting company rather than a real tech company that's trying to produce a product. And so you can see here, there's stories here that there was frequent travel, business and first class, instead of just doing an online meeting. Or here, instead of hiring tech people, they started hiring bankers and guys in suits who don't know much about technology. And then there's a comment here that R3 had been missing its internal financial targets set a year ago. One saying 10x revenues are 10x short, and another describing the figure as laughably off. And then finally, the fact of their funding. They did a round of funding and got about 100 million last year in May. And if they had simply bought Bitcoin, that would now be worth a little under 800 million or 780 million. But what's 19 million amongst friends, right? So there was a paper released called Dandelion++ by Julia Fanti and a number of other contributors. And essentially it's a continuation of an earlier piece of work called Dandelion, which basically making the observation that on the Bitcoin network, it's possible for an attacker to try to connect to many, many different nodes and then observe the way the transactions are propagated amongst those nodes and then try to infer which node was the source, and then try to link somebody's pseudonym, which is their Bitcoin address, against their IP address. And that, obviously assuming they weren't using a VPN and so on. But once somebody can tie that use of a Bitcoin address against an IP address, that makes it a little bit easier now for somebody to try to de-anonymize you as a user of the Bitcoin network. So Dandelion is like a response to that, and what it does is it helps change the way nodes will propagate the transaction out in such a way that it makes it difficult to do this sort of network-wide de-anonymizing attack. And so while this new approach that they're proposing won't stop a really targeted attacker, it will provide some level of defense against broad de-anonymization attacks that are currently feasible. So it's really quite an interesting concept. And so this is an example of how there's a lot of research being done to help improve the privacy within Bitcoin. And from a talk in September 2017, last year, Greg Maxwell, who is a Bitcoin Core developer, referred to this Dandelion protocol and how it's a potential future feature coming to Bitcoin. So again, some great examples of work being done in this space. So while the previous item related to Bitcoin layer 1, this next item relates to one of the upper layers, which is called Lightning Network. So it's called Increasing Bitcoin Privacy Using the Lightning Network, or How to Delete the Origin of Your Bitcoins by Toronex. And so just a quick summary for people who don't know what Lightning Network is. Think of Bitcoin as layer 1, and then Lightning Network is a layer above Bitcoin where people can open a payment channel with somebody using a layer 1 on-chain transaction and then use that payment channel to make payments for very, very low transaction fees. We're talking less than 1 US cent in terms of the fee at the moment. And what you can do is it will allow multi-hop. So just if I've got a channel to you and then you've got a channel to your friend, I could pay your friend using that channel that I have with you as an example. And then what it does is it allows people to do many, many more transactions much cheaper. But this article is talking about how actually it can also help improve the privacy of the users. So what it's referring to here is this protocol or this method called Sphinx. And so basically what it does, and it's referring to one of the Lightning specifications, Bolt 4, which is called onion routing. And so it's got here, intermediate nodes forwarding the message can verify the integrity of the packet and can learn which node they should forward the packet to. They cannot learn which other nodes besides their predecessor or successor are part of the packet's route, nor can they learn the length of the route or their position within it. So, like, just to translate that back into English, let's say we had set up a chain of 4 or 5 people. What it does is it constructs the transaction in such a way that you can send that transaction to the next person, and they will only know who the next person is. They don't know the full route. So then, taking that principle and applying that, Toronex is sort of making this point that you could actually set up multiple Lightning Network nodes on opposite ends of the network, so to speak, and through transacting to yourself via all of these different nodes, you can help delete the origin of your Bitcoins. And this is a great example of how Lightning Network on layer 2 of Bitcoin, or layer 2 and plus of Bitcoin, is helping create more and more privacy for the users of Bitcoin. And also, there are future features coming that will take this even further. So we've got atomic multipath payments, which is another feature that's coming in the pipeline, and that one will basically allow people to sort of do a payment through multipath methods. So again, making it even more hard for an attacker to try to de-anonymize you or impinge on your privacy. Also, there are features coming such as atomic swaps, which allow people to swap, say, Litecoin for Bitcoin on the respective Lightning networks of each chain, of each coin. So this is a great example of how it's a little bit more theoretical at the moment, and it would take some level of technical competence to do this, but I think this will come over time, and people will find ways to automate this process and just make it a no-brainer for anyone to wash their own coins. And this actually is a great thing because it provides a lot of privacy. So we can now see that there's improvements coming in layer 1, Dandelion, and improvements coming on higher layers of Bitcoin, such as Lightning Network. So this week we also saw the release of BetterHash by Matt Corallo. He is a Bitcoin core dev, and it is a new mining protocol that can help decentralize the network even further. So a bit of context here. Bitcoin on the whole is more decentralized than any other cryptocurrency or ICO project. However, there are still some slight mining centralization concerns. It's not that any one particular mining pool could attack Bitcoin. Perhaps 3 to 5 large pools, if they were to combine together and try to attack Bitcoin, or if a hacker tried to attack the 3 to 5 large pools and get them together to attack Bitcoin, that's a possibility. So the thing to understand here is the existence of mining pools and the way that it evolved as it is now. It could not have been foreseen by Satoshi and some of the earlier developers back in 2008 and 2009. And some centralization just did occur in the way that miners connect up with pools to help reduce their variance. So just a quick example there, you might be a miner who runs certain mining equipment, but you might not have enough mining equipment to regularly get a block or to find a block because it's probabilistic. So let's say you only have 0.001 of the hash power. Well, it might take you like 6 months or a really long time to find a block. And in that time, you would still be running electricity costs and all the other costs associated. So what people did is they formed into pools. So there'd be a pool operator and a miner. And then so the miner would would sort of work with that pool, and the pool would find the block and create that block template, and then it would then distribute out the mining rewards to each of the individual miners. So what this proposal does, and it's quite clever, is it actually separates what's called the block construction process from the payout process. And in doing so, it makes it so that the miners get a little bit more control over how they run their operation. And so what this does is it helps reduce some of the risks that I mentioned before. So it means now that it would be a little bit harder for a pool to sort of commandeer or be commandeered and be directed towards doing a 51% attack or some sort of selfish mining attack or some kind of censorship attack where maybe they censor certain transactions from certain people or to certain people, or just to try and stop those transactions and not mine them into a block. So what it does is it kind of gives some of that control back to the user and the owner of the mining hardware. So even if large miners, not necessarily the pools, adopt it, it still greatly helps Bitcoin's decentralization. So if you're interested in more, I recommend you check out Matt Corrallo's interview with Jimmy Song. He does a nice overview on it there. So today we've gone through some stories on ICOs and the token economy, and that we're right to be skeptical of some of these ICOs. We're starting to see the beginnings of the collapse of the blockchain not Bitcoin narrative. We're seeing work being done to help improve privacy both on layer 1 of Bitcoin through Dandelion and through layer 2, the use of Lightning Network and the onion routing. And lastly, we're starting to see mining protocol improvements that will help provide efficiencies for miners. It'll help decentralize mining, and it will reduce the risk of 51% attack on the network, or of selfish mining, or of transaction censoring by pools. So hopefully that's been useful for you guys. If you found value in that, please give me a like, comment, and subscribe, and also give me any feedback on Twitter. Thanks guys. See you in the next one.